Assalamu alaikum, guys. Today we are from Pablo Group will present about accounting policy choice. Before we start, this are group members. So, what exactly is accounting policy choice? The accounting policy a company selects can significantly affect how its financial health appears to others. For instance, it can change the amount of profit reported, the tax a company needs to pay, and the value of assets shown on the balance sheet. These outcomes directly influence how investors, creditors, and regulators perceive the company's financial position. Definition of accounting policy. This refers to the selection and application of specific accounting principles, methods, and procedures that a company uses when preparing its financial statements. In simple terms, accounting policies determine how transactions are recognized, measured, presented, and disclosed in the financial reports. It's important that these policies align with a recognized accounting framework, such as IFRS or GAAP. Moving on to the concept of accounting policy choice. Accounting standards often provide more than one method for recording certain transactions. For example, companies can choose between different methods for inventory valuation or depreciation. This means management has the discretion to choose the policy that best reflects the company's actual business operations. Accounting standards often provide more than one method for recording certain transactions. For example, companies can choose between different methods for inventory valuation or depreciation. This means management has the discretion to choose the policy that best reflects the company's actual business operations. Apply their chosen policies consistently from one period to the next. Disclose these policies clearly in the notes to the financial statements, and justify any changes, applying them according to accounting standards like IAS 8 under IFRS. The evolution of accounting. Ancient origins. Mesopotamia, c. 500 BC, used clay tablets to record trade and agricultural transactions. Egypt and Rome developed structured systems for auditing, taxation, and public works, growth alongside civilization. Accounting evolved with writing, counting, and the use of money, became essential for managing increasingly complex societies, the birth of modern accounting. 1494, Luca Pacioli published Summa de Arithmetica, introduced double-entry bookkeeping, concepts of debits and credits, journals and ledgers formalized. Pacioli, known as father of modern accounting, an industrial revolution, 18 to 19, the century. Expansion of businesses and commerce. Need for standardized financial records and accountability. Corporations and investors demanded reliable reporting, digital transformation. Introduction of computers, spreadsheets, accounting software. Growth of cloud computing and automation, AL. Use of blockchain for secure, transparent transaction.
Next, let's go to the factors influencing choice. When it comes to choosing accounting policies, companies are guided by a few important factors. First is the regulatory framework, such as IFRS. These standards must be followed, but they often allow flexibility. For example, standards often allow multiple acceptable methods like depreciation or valuation options. Second, the nature of the business and industry. Different industries have different financial needs. A tech company will have very different assets and revenue models compared to an agricultural firm. So, accounting choices often reflect those operational differences. Finally, there are financial reporting objectives. Companies that prioritize transparency and comparability tend to adopt more conservative policies. This helps build trust with investors and makes it easier to meet regulatory expectations.
Let's look at how major companies make different accounting policy choices and how these decisions impact their financial reporting. First, Walmart uses the LIFO method to value inventory in the U.S. This approach raises the cost of goods sold during inflation, which lowers taxable income and net profit. It's a strategy that can reduce tax burdens. In contrast, Amazon uses FIFO for its inventory. This results in higher reported earnings during periods of rising prices, but also leads to higher taxes. It's more favorable when a company wants to show stronger profitability. These examples show how accounting choices, even when following the same standards, can shape the way a company's financial health appears to stakeholders. Impact, effective accounting policy in the context of fraud. 1. Distorted financial statements. When policies are manipulated, numbers can be made to look better than reality, like inflated profits or understated losses. This misleads investors, lenders, even regulators who think the company's doing great when it's actually not. 2. Exploitation of flexibility. Accounting rules give choices, like how to treat depreciation or revenue. But if done with the wrong intent, these choices are used to cover up fraud while still looking legit on paper. 3. Loss of investor confidence. False financial reports build false confidence. When fraud is exposed, trust breaks. Investors pull out, share prices fall, and the company's reputation takes a long-term hit. 4th, legal and regulatory consequences. Policy manipulation isn't just risky, it can be criminal. If it shows intent to deceive, it opens the door to penalties, lawsuits, and even jail time. Risk refers to the potential for errors or misjudgments in financial reporting that arise due to misrepresent economic reality. An inappropriately chosen policy, even if compliant with standards, might not accurately reflect the company's underlying economic performance or financial health. This can lead to a disconnect between the reported numbers and the true state of the business. Secondly, reduce comparability. If companies in the same industry use widely different accounting policies for similar transactions, it becomes difficult for investors and analysts to compare their financial statements and performance. This lack of comparability can obscure industry trends and individual company performance. While manipulation occurs when management intentionally exploits the flexibility in accounting standards to distort financial results and mislead stakeholders, meeting or exceeding earnings expectations, to satisfy analysts' forecasts, maintain investor confidence, and boost stock prices. Improving access to capital, presenting a healthier financial picture to attract more favorable terms for loans or equity financing. To conclude, accounting policy choice is more than just a technical formality. It's a strategic decision that shapes how a company is viewed financially. While some flexibility is allowed under accounting standards, it must be used ethically and applied. Above all, transparency and policy disclosure builds trust and supports